Today I would like to analyze Wendy's. It's one of the biggest fast food restaurants in America. And if we take a look at the 1 year chart, we can see we are down close to 23%. And in the 5 year charts, we are down close to 31%. So it's looking very interesting about the stock price. Maybe this company can be undervalued. So we have to take a look at the financials to find out. So the first thing we can recognize is the market cap of 3.05 billion US dollar. So this is when we take the current stock price multiplied with the shares outstanding. And I would say it's still a small company which has a lot of room to grow in the future. We also have a dividend yield of 6.69%, which is very big dividend in my eyes. So we need to check the financials if this company can sustain this dividend and if this company is actually undervalued right now. So now we're going to take a look at the financial foundation. The first thing we are looking for is revenue growth in the last 5 years. We can see here 2019 it was around 1.7 billion. Then we have the slow increase around 1%. Then we have the stronger increase around 10%, 10% again in 2022, and then around 4% in 2023. So it's looking good actually about the revenue growth. It's a check here for me. Now we would like to see the free cash flow growth in the last 5 years. This is a very important number because the free cash flow can be used to buy back their own shares, to pay the dividend, to invest in their own business, or to pay back the debt. So it's very important. We can see here 2019 it was around 214. Then we have the slow increase. And then we have the stronger increase in 2021 around 24%. Then we have a strong decline in 2022 around 34%. And then we have the strong recovery again in 2023 around 49%. So it's mixed results. We have a strong declines and we have the recovery. But overall in 5 years it did grow. So for me it's a check here. The next thing we are looking for is free cash flow yield over 4%. This also can show us a bit about the valuation of this company. So if it's under 4%, it could mean the company is overvalued right now. So what we're going to do is we're going to take the free cash flow in 2023, 260, and then we're going to divide it with the market cap. And then we're going to get the free cash flow yield for 2023. So what we're going to get is 0.085, which means around about 8.5% free cash flow yield, which is really good. They have a lot of free cash flow. Of course, I'm using the number in 2023, so in 2024 it could be different. But it looks very good, and it's a check here for me. Now we would like to see the debt to free cash flow ratio under 5. So what does this mean? It means the company can pay back the debt with the free cash flow in under 5 years. It's a very important number because if a company has too much debt, it can risk to go bankrupt. So we don't like to see that. So what we're going to do now is we're going to take a look at the debt. First, we're going to take the short-term debt here. 98. Then we're going to take the long-term debt as well. I would prefer to use the long-term debt excluded capitalized leases because I think it makes more sense to use this number than this number. So we're going to add it. And then we're going to divide it with the free cash flow. And then we get the debt to free cash flow ratio. So we get this number 10.87. So what does it tell us? It tells us it's not looking good about the debt to free cash flow ratio. We would like to see it under 5, and it's over 10 actually. It means in a little bit over 10 years, they can pay back the debt with the free cash flow. And we even used this number. So if we would use the 4 billion instead of the 2.7 billion, it would look even worse. So about the balance sheet, this company is not looking great. So it's not a check here. we can take a quick look at the cash on hand, because it's also important that they have some money in the bank. And we can see here around 588 million, which is not bad actually. They can use this to pay back some of the debt or to invest in the business. But still, overall, the balance sheet is not looking great in my eyes. So the last thing we are looking for is shares outstanding decrease. This means the company buys back their own shares. We would like to see that, especially if a company is undervalued in our opinion. So what we see here, they did buy back a lot of shares and many years in a row. We can see here shares decrease, and it's a strong number actually, close to 3% sometimes. And that's good actually if the company is undervalued in our opinion. I'm just concerned about the debt level, and they buy back their own shares and they have a lot of debt. So this can be risky, but it definitely helps the stock price that they buy back their own shares. We can take a look at the cash flow, and then we're going to see they buy back their own shares. In some second, we will see it here. Repurchase of common preferred stock. Yeah, they buy back a lot of shares and many years in a row. And here we can see they pay a lot of dividend as well. In 2023, around 209 million. And they use a lot of money to buy back their own shares. So it's actually, considering the dividend and the repurchase of shares, they use more than the free cash flow. So this is concerning, especially with the debt level they have. So actually it's a check here, but in my opinion, it's risky what they do. I would like to give my conclusion about this company. So let's start with a positive. They have a good revenue growth in the last 5 years. They have a high dividend yield around 6.69%. They have a high free cash flow yield around 8.5%, which is very good. It can mean the company is undervalued right now. But what is very concerning is a high debt level. So they have a lot of debt. And I think they not managing the money quite well, because they pay a lot of dividend and then they also buy back their own shares. So they have less money left to pay back the debt. And I think it's quite risky, especially right now as the interest rate is quite high. So the debt becomes more expensive. So what they're doing is risking the company actually. I think it would be better to lower the dividend, to lower the stock buybacks, and to pay more of the debt. This is more better for the long term, because it will risk not the company to go bankrupt. And I think it's look undervalued in some way, but it has a lot of risk as well. So I think this company has potential, but it needs to manage the money better in the future.